U.S. moves to control Venezuelan oil has led to questions about the future competitiveness of the Canadian energy sector. But how much of a threat is it to company profits? Joining us now to discuss is Raja Kalra, VP for Investment Grade Credit Research with TD Asset Management. Thanks so much for joining us on this. Let's start with talking about why the situation in Venezuela is a potential threat to Canada's crude industry.
Yeah, thanks for having me, Greg. It's definitely interesting times with the geopolitics that's unfolding in Venezuela. So what President Trump is trying to do is he's trying to revive the Venezuelan oil industry, bring more investments and, ultimately make those Venezuelan barrels flow back to the U.S. Gulf Coast. Now, it definitely has implications for Canada's oil sector. So both Venezuela and Canada, they produce heavy oil that's consumed by the U.S. refineries. There's similarity in geology there. So if you go back in time, a lot of the Venezuelan heavy oil used to flow to the U.S. and that was used by the Gulf Coast refineries. And over time, that number has declined quite a bit due to a series of events that happened. It was the nationalization of oil companies in 2007 for the second time, the sanctions in 2017. At the same time, exports from Canada has increased meaningfully. So if you look back at 2009, between then and now, exports from Canada has increased more than 3 times to the U.S. So there's definitely that competition. And what we've seen, the discount at which the Canadian heavy oil trades versus the benchmark WTI prices, that has widened since the beginning of the year. So it was at $13 and now it's 14.5, and the forward curve is pointing to $15 to $16 by the end of the year.
Okay, so against that backdrop, let's start breaking it down what it means for different parts of the Canadian industry. Let's start with the big producers.
Yeah, sure. So, the wider discount means, impact on profits, free cash flows, and ultimately the shareholder distributions. That being said, the big producers are less impacted than the smaller players. And that's for a number of reasons. The big producers have low break-even costs. The balance sheets are in great shape. And then, some of them have, good upgrading capacity or refining capacity. So if you think of the 3 big producers, you have Suncor, Canadian Natural, and Cenovus. So Suncor is the least impacted because, it has, a lot of refining and upgrading, which produces end products which are higher priced. And then you have Cenovus, which has a little more exposure to heavy oil, but then it also has refineries in the U.S. Midwest, which kind of provides a partial hedge here. And then C&Q is somewhere in between. And then if you look at it from like a broader geopolitical lens, what happened, with the unfolding situation in Iran, we saw WTI prices go up by 3-4% at the beginning of the week, and they've since reversed. So a $3 widening in the discounts can sometimes get eclipsed by some of the other geopolitical impacts that have an impact on the WTI pricing. And keep in mind the break evens for these companies are in like low to mid 40s. And, with WTI pricing close to $60 a barrel, there's still a lot of buffer before you see, some impact on the returns here.
All right, so those are the big producers. What about the energy infrastructure companies? What could be the impact in this space?
Yeah, so there's not that much of an impact on the energy infrastructure company or the volumes that flow through these pipelines. So if you think about the current volumes that come out of Venezuela, we're talking about 900,000 barrels a day, and that's expected to go up by say 200 to 500,000 barrels a day to moving to 1.2, 1.4 million barrels a day. And those volumes can easily be either absorbed at the U.S. Gulf Coast or they can be shipped elsewhere from the U.S. So it doesn't really impact the flow of crude from Canada to the U.S. And if you think of the midstream names, whether it's Enbridge or South Bow that move crude from Canada to the U.S., they're highly contracted. What would have to happen to really, bring about a structural change here is Venezuela production would have to ramp up significantly to say 2 million barrels a day, or to that 3 million barrels a day. What it did at its peak. But there's a number of bridges that needs to be crossed to get that. We need fiscal guarantees, we need political guarantees, tens of billions of dollars of investment, and we don't know if we really have a path to get there at this point. We've heard Exxon say that Venezuela is uninvestable. So really what it seems like, we're talking about 200 to 500 barrels a day of extra production over the next couple of years. And that doesn't make a structural change here, and thus it does not impact the infrastructure names.
All right, so very interesting there. What will you be watching for then on the credit side going forward for the energy space?
Yeah, so credit is definitely less impacted than the stocks, because the dividends can go up and down with the change in profitability of these companies, but then the coupon or the yield on the bonds are contracted; they don't change, and that's exactly what we saw. When the news came out on January 5th, the stock markets reacted, but the bond markets have not reacted. That being said, we've come into this year with very tight valuations on the bond side. So the aggregate Canadian bond index has a spread of 84 basis points over the Canadian government bond yield, which is the incremental yield you get to invest in government, to invest in corporate bonds versus the government bonds. And that has come down year over year. So last year, at the end of 2024, we were at 98 basis points, and the year before we were around 130 basis point. So we are at very tight levels. So there's less opportunity for further compression or valuation upside on the bonds, but then there's more potential for some widening. So the active fixed income team is super focused on, not only sector selection, but individual security selection within the sectors. So, if we talk about energy sector in particular, different pockets of the sector are going to perform differently. The infrastructure names would perform differently than the producers. But then even within that, you have, different nuances. Like, we have a really good outlook for natural gas. So name like TC Energy is a big beneficiary of that, whereas the crude outlook is not, as great, but then you have contracts and other things that kind of offset that. So I think security selection is going to be really important this year.